All right, good afternoon, everyone. Welcome to this week's regional report, a very special regional report. This is part one of a two-part series. Part one is on investment perspectives. We have a great panel joining us today. We're close to 500 RSVPs, so we're expecting a very engaged audience. My name is Eric Sperling. I'm the Managing Director at the Social Television Network. If you're not familiar with STN, we are a local media company here in Phoenix, Arizona. We have a streaming network where all of our shows and segments are dedicated to local leadership, community growth, actionable solutions. That's where we met GPEC and their president and CEO, Chris Camacho, and so excited to partner with them on this virtual series. We also want to acknowledge for this particular episode, our I6 Challenge partners who made this two-part series possible and the Greater Phoenix Tech Challenge possible. Those partners are Arizona State University, the Center for Entrepreneurial Innovation, the Partnership for Economic Innovation, the Startup AZ Foundation, Arizona Community Foundation, Packey Center for Business Philanthropy, who is funding the Greater Phoenix Tech Challenge, and of course, GPEC, or the Greater Phoenix Economic Council. Now, these organizations are working together to develop regional innovation strategies through the U.S. Economic Development Administration's I6 Challenge, and have all been integral partners in the development of WearTech. That's an Arizona-based applied research center dedicated to advancing wearable technology innovation. So again, thank you so much to those partners. Now, if this is your first time joining us, we have some housekeeping items as far as these regional reports go. Today's webinar will last for approximately 1 hour. Audience members will be muted and without video. Reminder that this webinar is being recorded and will be shared on the GPEC website and social media. You may submit questions using the Q&A feature at the bottom of your screen. We do encourage that, but due to time constraints, we may not be able to get to all of your questions. Should you experience any technical difficulties, just try the old log off and log back on, check your connection, and hopefully that works. And then we, of course, invite you to share this information on social media. Please feel free to tag GPEC and use the hashtag Greater Phoenix Together where appropriate. And I mentioned this is part one of our two-part series. The next regional report will be the Greater Phoenix Tech Challenge. May 28th, 4 Greater Phoenix-based businesses and or nonprofits will present their technology, highlight how they have pivoted their operations to meet the current demands of the COVID-19 pandemic. The businesses are vying for a $50,000 grant provided by the Packey Center for Business Philanthropy at the Arizona Community Foundation. Audience participation, of course, will be encouraged during that webcast. Applications for the grant are rolling in, and we do have a deadline. The deadline is May 22nd, so be sure to apply quickly if you haven't done so yet. Okay, on to episode one, today's panelists. Today we are hearing from Leib Bolel, venture partner at Grayhawk Capital, Sydnie Keddington, a VC associate at Kickstart, Tim Kelley, chairman and founding member, Canyon Angels, Grand Canyon University, Ulya, operating partner at Virgo Investment Group, and Brian Yee, partner at ACME. All right, we are going to start with Leib. Leib is a venture partner, as I mentioned, at Grayhawk Capital. He's also the president and CEO of the Arizona-Israel Technology Alliance. He has over a decade of experience in the world of startups, including new business development, acquisition funding, and general operation management. Okay, Leib, our goal now is just kind of toss it over to you and get your industry perspective on what you're seeing during this time.
Sorry about that. Thank you, Eric, and thanks to GPEC for having me on and the great work that they do within our region and the economy. So just a little bit of background on Grayhawk. We're Arizona's most established fund. We've been around since 1999, and we're proud to be based in Arizona. We've made 18 investments in Arizona with a value exits of just over $690 million, and we've invested over $56 million into Arizona companies. We focus on primarily the Southwest with a new focus on Israeli investments. We look for B2B business-to-business SaaS companies that are generally Series A, Series B, and generating between $2 to $6 million in annual recurring revenue. So being involved in, being based in Arizona, we love to be part of the ecosystem and work with collaborative efforts to further both the economy here and the tech sector here. As an overview of what we're seeing today, from Grayhawk's perspective, I think there's a couple of things to bear in mind. I think there's the venture capital scene that's happening within the funds themselves, in addition to the startups and the challenges that they have. And I think it would be beneficial to look at some of the cycles on both when early stage startups or companies that are raising capital have started engaging with VCs. Prior to COVID-19, we didn't know what was coming. Companies didn't know what were coming, and they were just going about business as usual as it was everywhere else. Once COVID-19 came, the companies that were already in dialogue with funds, what we've seen on our end, we've continued those conversations. And that's because funds that have capital to deploy are not looking to take a step back, or we haven't taken a step back, especially if there's capital to deploy within companies that, whether it's through prior diligence that we've done, or whether it's through the comfortability of the situation and how that's not going to affect the investment strategy. If we look at companies that are engaging now, that's definitely something we want to take a look at and see, is this the right sector that we could see that is going to be unaffected? How does that play into the long term? I think the timelines of investment of companies that are engaging now may be pushed back a little bit, but from a Grayhawk perspective, we are business as usual. We definitely took a couple of weeks off to really get grips as to the complexities of the investment sphere, and see, is this going to be really long-term? How detrimental is it going to be? With a focus on technology, we're in a position of where technology is really driving a lot. And technology, specifically on growth scale companies, has not been affected with the likes of whether it's going to be on the manufacturing side or device side, whether it's physical infrastructure. I think it's something which is important for companies who are looking to raise capital to understand the life cycles of venture funds and of funds on how we operate and the cycles that we go through, because there is a lot of capital currently waiting to be invested. And there are funds that are in fundraising mode, understanding that there may not be as much capital for that fund to invest in, specifically if they've got multiple funds behind them. And even if a fund is taking a little bit of a pause, but that fund is well networked, has co-invested with other funds, leveraging their networks could be a huge opportunity for companies that are looking for funding and seeking for funding. I would say, just as a matter of principle, companies that do not need to raise capital shouldn't raise capital if they don't need to, unless they're looking for strategic partners, which a fund could be, a fund could add value on those perspectives. We love working with our companies. We take an active role, and specifically within the environment that we all have a focus on supporting our current companies, and that is the #1 focus that we have. We are active in investing. We are still meeting all virtually and via Zoom, and we look forward to supporting more Arizona companies, more companies in the United States. We are in business mode. But giving that overview, I think it's something that companies that are looking to raise capital, it definitely varies from stage of company, whether it's going to be early stage, whether it's seed, A, B, C. Don't worry about reaching out. We still want to hear from companies, and we like to get to know companies. So even if an investment isn't relevant right now, it could be relevant in 6 months' time.
All right, Leib, thank you so much for all that perspective. We are going to bring you back for some Q&A at the end of our seminar, but we want to transition over now to Ulya. Ulya is the operating partner at Virgo Investment Group, a PE firm with $1.8 billion under management. She's also a founding member of the Phoenix chapter of Global Seeds, one of the nation's most active early stage investment firms focused on women-led businesses, and she has over 25 years of experience in major corporations. So Ulya, I'm going to transition over to you to get your perspective on what you're seeing in our current landscape.
Thank you, Eric, and good afternoon, ladies and gentlemen. It is my pleasure to be joining you today to share our investment perspective at this session. And by way of background, my own investment focus is primarily on the healthcare side, with special interest on the longevity, wellness, and healthy aging. So I will provide my answer in 3 parts, because I don't do venture. but I do private equity, and through Golden Seeds, I also do angel investments. So I'm going to provide an answer with like macro picture post-COVID-19 and what we are seeing, and then honing in a little bit as to what the private equity side is doing versus what I'm seeing on the angel front. So at a macro level, what we are seeing is institutional investors. About 10 weeks ago, we all pressed the pause button. And the reason for that was, when there's uncertainty in the markets, the large investors like to wait and see. Plus, we also wanted to make sure that the first focus, and actually Leib commented on that as well, is to protect your existing investments. So a big focus on hanging on to the investment dollars to see which companies in our current portfolio on the Virgo side need further investments. And so Virgo has about 250 million on the healthcare side. So the rest of the dollars is split between aviation, media, entertainment, etc. So you can just imagine the kind of companies that are in our portfolio. The other thing that we're seeing is there are clear winners and losers in a post-COVID-19 world. So I'm seeing a lot of black and white in terms of companies that were being told that there's a glut in the marketplace of telehealth and telemedicine solutions. Suddenly saw in 2 weeks, they did their entire year's sales quota. And they are seeing unprecedented growth with investors chasing them with their checkbooks. The other thing we saw with COVID-19, and that was, again, a very positive thing, is the policymakers becoming more agile in terms of changing reimbursement policies, which now has finally pushed telemedicine and telehealth into mainstream. And I don't believe there's any going back there. On the angel front at a macro level, we continue to see angels being very opportunistic about investments. And I'm seeing most of the angels doing many follow-up investment checks, on that side. So coming back to the private equity perspective, number one is protecting your capital and existing investments. We are being very deliberate and opportunistic in terms of new investments. So we have a pipeline of companies that we are looking at and watching, but we stopped all investment conversations with companies that we were having pre-post COVID-19. We actually just made one investment in March because it was so far advanced that we thought the right thing to do would be to close that deal. Starting this week, though, we are now revisiting and updating our investment thesis to factor in the COVID-19 effect on our investment thesis. Moving on to the angel perspective, so Golden Seeds, as Eric mentioned, I am part of the founding team on Golden Seeds, which really finds high potential women leading high potential business opportunities. So we are again seeing many companies that had some other businesses and suddenly COVID happened, and they were able to so effectively pivot their businesses to service the COVID-19 world. And that includes businesses that do nurturing conversational chatbots to the ones that were doing diagnostics and other digital health companies. There's one company specifically that was doing like a good housekeeping sales of approval for dating websites to say that a person is free of STDs. Well, guess what? A very natural extension for them was COVID-19. From also the angel perspective, our focus continues on coaching and mentoring the entrepreneurs and management teams, especially helping them navigate the post-COVID-19 markets and this new uncharted territory. On a Phoenix side, what we are actually seeing is really, really high quality entrepreneurs and high quality companies coming up, so much so that we work very closely with the Silicon Valley chapter of Golden Seeds. And most high potential companies these days are coming from Phoenix and from Arizona. Silicon Valley pipeline doesn't seem to be as active right now, so we are the ones supplying them companies. And 3 of our Phoenix companies are right now in due diligence and deep dive for investment purposes. So I think I will stop there and wait for follow-up questions later on.
Ulya, thank you so much. I'm just, writing down again, that's encouraging to hear a lot of high potential coming out of Arizona. And we will bring you back for some Q&A in just a few moments, but let's send it over to Brian now. Speaking of Silicon Valley, Brian is a partner at ACME in San Francisco, focusing on investment opportunities in consumer, digital healthcare, and fintech. He sits on a number of boards, and he was involved with the firm's investments into Airbnb, Billy, Rent the Runway, Robinhood, Uber, and many more. He was previously at General Atlantic, a $20 billion growth equity firm, and he does have Arizona roots. Early in his career, Brian was a congressional intern for Arizona Senator John McCain. Brian, thanks for joining us, and we'll send it over to you now for some perspective on what you're seeing.
Thanks, Eric, and happy to be on the panel today. Just a bit of background, as Eric mentioned, currently run with two partners, a $200 million, primarily Series A investment firm that focuses primarily on technology or tech-enabled service type of businesses. We are thematically focused investors and have been investing, I think, relative to whatever is going on right now, unfortunately, at the cross-section of consumer and healthcare for the past 5 or 6 years. And so I've done a number of those investments in the space, have also done a number of investments in the emerging commerce category as well as vertical software. And if I level up my thinking for a bit and just think about the life cycle of our business, you know, we clearly have to raise capital from limited partners. We have to be good fiduciaries and invest that capital. Once we invest that capital, we got to figure out how to add value to those companies, and at some stage, figure out the appropriate exit opportunity. And so if I break it down into those 4 buckets and how COVID has affected those 4 categories, certainly on the LP fundraising side, and it's probably different for each fund. I think we're fortunate where we have a good, healthy mix between strong institutional investors, endowments, pension plans, large corporations, and then some more institutional family offices. If you look at the venture asset class over these market cycles, the vintages that actually come out of these big disruptive events, whether it's 08, 09 or the tech bubble in early 2000s, the vintages right afterwards are sometimes, actually more frequently, the best performing vintages. And so it's important to keep that contrarian mind and understanding that by the time these companies sort of come to fruition, because we're investing at such an early stage, they are actually on the upswing with respect to how the economy and market is faring. And also at the same time, we've seen a mass, I think Leib made the point of this, so much capital is on the sidelines and pervasive. You've had a number of sovereign wealth funds, you've had a number of traditionally public market investors, venture funds that now have billion-dollar plus funds, all focused on innovation and technology. And so we think it's going to be durable. That said, you've also had a lot of people that, you know, that have been more kind of venture capital tourists, where the number of first-time funds over the past 5 years has never been higher. And so we think that it's an interesting environment where sort of the experienced investors that have invested through market cycles can be a little bit more selective and quite frankly get promising valuations. But that said, it's you know, I'd say that the limited partner ecosystem, again, it's the rare ones that are contrarian and are viewing this as an opportunity. I think overall, investors across the board, whether they're limited partners or general partners, are taking into account and not being too quick to sort of rush in, given so much uncertainty in how this pandemic is going to play out. In terms of the portfolio work that we do, I think like many others, there was initial, call it 4 to 5 weeks of portfolio triage. Quite frankly, there's a couple of other situations that I'm, you know, still require a bunch of my time. And sometimes this is the hardest conversations that we have to have with our founders. You know, the vast majority of the companies that we invest in are unprofitable. And oftentimes the hardest decision to make is that follow-on check versus the initiating check. When you're making that initiating check, everyone is very optimistic and enthusiastic about the prospect for the business. And just again, not every investment goes well. Quite frankly, the majority of the investments don't go as planned. And so you really just have to have, I think, both an infrastructure and framework for some of these decision making. When in terms of our policy, when we consider a follow-on round that's in excess of our pro rata for a company that is doing maybe okay, but not hitting their plan, I can't necessarily green light that on my own. I have proper checks and balances where another partner that isn't as close needs to be convinced and really advocate for that follow-on capital. And again, every situation is different, but it's, you know, the whole adage of following good money after bad is never been truer in this environment, and it's really testing the investment frameworks that we have. I think fortunately, as it relates to our portfolio, because we've been overweight consumer e-commerce, because we've been overweight digital health, the portfolio has been fairly resilient. And then in terms of new deal flow, for sure, you know, we're definitely open for business. No venture firm's going to tell you that they're not open for business, but just the reality is we've seen deal flow probably decrease 60, 70, 80%. And I think for one, a lot of these venture firms are internally focused, trying to make sure that the portfolio companies that they have are well capitalized and are managing through this dynamic. I spent a ton of time helping our founders think through the PPP loan application process. A lot of the first-time founders that we have never gone through a layoff before. So how do they think about cost rationalizations and laying off people for the first time? These are emotionally trying times for founders, and certainly, you know, try to give them as much support as possible. But look, the new deal flow activity has certainly come down, and we're hopeful that it does pick back up. And I think what it's allowed us to do is sort of just take a step back, because I think over the past 3 years, particularly in the Bay Area, it become like a frenzy, right? You had way too much capital chasing, you know, just a finite number of companies, and valuations were getting sort of out of whack. And I think this has just allowed everyone to take a step back, be even more thematic and thesis driven than many of my colleagues already are, and really try to figure out what the new normal is going to be and who's going to benefit from it. I guess the last thing I'd say is on the exit front, this is certainly delayed the exit environment, certainly from the public market perspective, and unknown how the M&A environment is going to evolve as well. I think you've seen a number of opportunities, at least in our portfolio, of larger companies reaching out, just understanding that a lot of these companies, again, are unprofitable and may have to raise capital, and they may be some opportunities there. So we haven't seen the highly strategic, high valued M&A come back yet, but certainly I'd imagine that the larger platforms are, you know, chomping at the bit to pick up some deals.
Absolutely, Brian, and thank you for bringing up the Paycheck Protection Program. We did have a question come in specifically for you. We'll get to that hopefully at the end of the webinar, and I do want to remind the audience of the Q&A function at the bottom of your screen there. If you hear something or if you have questions, please submit them there. And just like we'll try to get Brian's question over to Brian at the end of the webinar, you can submit those questions there. Okay, I want to transition over now to Sydnie. Sydnie joined the Kickstart Fund through her work with the Campus Founders Fund, a $500,000 venture-backed seed fund designed to propel student-founded startups. She's also on the board of Invest Southwest. So Sydnie, excited to kick it over to you to get your perspective.
Thank you so much, Eric, and thank you all for having me. So I'll briefly start with a quick overview of Kickstart and who we are. And I just quick disclaimer, my internet has sort of been a little bit choppy. So if you can't hear me, let me know and I'll call in or whatever I have to do, but hopefully this works well. So just kind of quick context on Kickstart. We started back in 2008. We are a seed stage investment group based in Salt Lake City. We are currently investing out of our 5th fund, which we were fortunate enough to have closed actually right before all of this unfolded. And so it was a $110 million fund, oversubscribed and bringing us just over 250 under management across all 5 funds. We have about 100 active portfolio companies, and we're geographically concentrated in businesses based in Utah and surrounding states, so really Intermountain West. And average check size is kind of $1.25 million, give or take, and we'll invest in earlier pre-seed opportunities with checks from the ranges of 100 to 600K, depending on kind of the stage of the company. And in this newer environment, I think that will be more of a focus for us in the near term, which I'll talk about a little bit in a minute. So I think broadly speaking, as we kind of look at this new environment, I think the first thing I would note is that just really this is, there's a real crisis here. And I think that's something that we're really cognizant of. There's a really major economic impact here. The stock market has really been rallying, and there have been trillions of stimulus dollars being pumped into the economy. And that's probably a large contributor to that rallying that we're seeing. And so, you know, the unemployment rates are at 15%, expected to increase dramatically, absolutely unprecedented. There are a lot of unknowns. We don't have a cure or vaccine yet. And I think in some ways, many of us have really sort of adjusted to this new normal. And really this is likely just the beginning in reality. And so I think that that's just kind of like for me, I try to kind of keep perspective on what is real, but I think on the flip side, on kind of more of an optimistic note, the types of companies and entrepreneurs that emerge during crisis and during times like these, are often sort of the greatest opportunities. You know, I think there's something to be said for a founder, an entrepreneur who has the type of conviction that allows them to really step up to the plate during a time like this. And so I think, you know, our perspective is that there are great opportunities ahead. There are a lot of societal and behavioral changes taking place right now, many of which will likely be sticky. And I think that that presents opportunities for new technology and innovation in the near term and in the long term as well. And I think, you know, coronavirus in many ways has activated and stimulated innovative capacity at the regional level, just within various communities. And so, as opposed to eliminating it. And so I think that's just important to bear in mind and to recognize that there are a lot of technology companies doing very well, responding. You know, we live in an day and age where we have the ability to leverage technology to kind of transition quickly to a distributed workforce. And so while there's a lot of, you know, challenges ahead and I think kind of a long road ahead in some ways, I think it's been pretty incredible to see how companies have rallied together and responded so quickly to the crisis. I think that in terms of what we're seeing as our companies respond, really, I think in the eye of a crisis, it's important to optimize for survival. That's what we've really been sort of encouraging and to our companies and into our community. There's really, I think, when that is the paradigm, there are different decisions that are made when kind of survival is the North Star. And as time moves on, of course, repositioning for thriving and kind of optimization for the business will be appropriate. But for right now, it's really important to, I think, focus on runway, take a conservative approach. You know, how do things need to readjust to really get us to a strong capital and cash position? Obviously, PPP process has been or was really kind of, there was a lot of navigating to be done through that. And I think that was something we tried to really be involved with and just kind of helping our companies understand what, you know, as things evolved there. And so that certainly helped many of our companies. You know, no question that we're seeing a lot of layoffs, as will be the case for many industries, but really just providing support wherever we can. And I think, again, on the runway point, pre-COVID, I think we'd be seeing companies kind of in the 9 to 12 month runway zone, whereas now it's going to look more like 18 to 24. And so really having to be conservative and understanding sort of what position do companies need to be in to really weather the storm. And really flexibility, nimbleness, and adaptability is just more important kind of now more than ever. I would say as well, I think it's important to note that, you know, especially in the realm of venture specifically, rewards have never been equally distributed in the world of venture. It is an outlier business. And I think that the pain of the crisis is also not evenly distributed. And so as some others have touched on and mentioned, you know, there are some businesses where we're really set up for accelerated adoption, depending on kind of the space and the industry. And then there are others that are going to be hit in a really dramatic way. And so I think it's just important for entrepreneurs to really understand clearly where they fit within that environment and taking a really thoughtful approach as pivots are made for both near-term and long-term impacts. I think fundamentally just getting back to the basics is what will be most important for both businesses and investors really in the same way. So, you know, I think, again, often some of the best companies are those that will come out of a crisis. And I think the other thing to note is that ventures long-term focused, and we can't get too caught up in the immediate crisis. And so many of these companies that will come are really sort of on a second and third order focus, where the behavior changes that we are seeing that will manifest post-COVID, it won't be necessarily clear that the winners are pursuing opportunities that are directly related to a virus, right? It's more these behavior changes that are sort of residual effect. So kind of all in all, I just say desire to invest has not gone away. Again, we're in a very fortunate position on our end where we recently closed this fifth fund. And so I think we're really looking for opportunities, kind of probably if anything's changed for us, it's maybe a higher volume of smaller checks, because there are a lot of opportunities, and I think we want to be a part of really supporting entrepreneurs that are rising to the challenge. And again, we love Arizona and the Intermountain West, so we're really excited to see what comes of this. And not, again, very, very clearly, there are some challenges ahead, but I think there are some really exciting opportunities ahead as well, and it's important to keep that in mind.
Well said, Sydney. Thank you so much. We will bring you back in just a few moments for some Q&A, but I do now want to bring Tim Kelley in. Tim founded Canyon Angels at Grand Canyon University in 2015, currently serves as chairman. Under his leadership, the fund has grown to over 60 investors, helping to fund approximately 30 different ventures. He is also the chairman of Invest Southwest and chair of entrepreneurship at Grand Canyon University. So Tim, thank you for being here. And now let's hear your perspective on what you're seeing.
So Eric, thank you. And I think everyone has covered so many bases about the atmosphere in which we're involved. What we've seen just as an angel group that is early stage, relatively small, kind of the guppies of the panel, if you will, we found it fascinating that we're now utilizing tools like Zoom to be able to engage deals more effectively with our members through a more remote platform, where in the past, getting people to come over to the west side of Phoenix is a logistical problem that we've had to deal with having roughly 8 to 9 meetings a year. We've already done our last May meeting in virtual form. We've got our June meeting scheduled out. We're hearing deals. We got 12 applications in the last 7 weeks. We are putting a focus for our next June session on artificial intelligence. We've seen 3 applications already related to that in a COVID sense. So we're starting to see some interesting deal flow and pivots on companies that had even approached us a month, 2, 3, 4 months ago, and literally pivoted their business model in the last 6 weeks and are actually getting new customers based on the new pivots. So we're kind of excited about it. We finished a deal in early April that actually combined our first investment from our sidecar fund, which matches what our individual investors do. So part of that is the residual momentum that we've had coming through, but also looking at our portfolio companies, and as an angel group, by portfolio companies, I'm not speaking of the entire 30 companies that members have invested in, but 8 in particular that we've funded through combined pooled vehicles. And several of those have moved into the Grand Canyon University Canyon Venture Center, which offers free rent and student employees. Now, granted, it's a bit of a hollow moment because the students have all gone, but they're working virtually. And we're seeing that as companies pivot to optimize costs, as Sydney mentioned, there are tools out there, and we feel that Canyon Ventures, as part of our portfolio offering to our companies in which we invest, can be a way to optimize those resources, improve sales, and actually pivot your enterprise. So we're excited, and we're not sure how all of our members will pool. I'm sure that some, we've seen a few hit dramatically. Others view this as a significant opportunity, and we're going to see how we pivot out of this. But I'm looking forward to the conversation and look forward to questioning coming up.
Absolutely, Tim, and let's continue that conversation and those questions coming in. Let's bring back Leib, because we haven't heard from you in a while. We have a specific question for you. Do you expect the pandemic will impact the market value of office buildings, considering many companies' employees now realize how efficient it can be to work from home?
Yeah, I think that there's 2 combining factors. I had a conversation with one of the co-working space in Phoenix yesterday, and I asked him how, what he's currently seeing. The feedback that I got from him was that the smaller companies are finding it a lot more challenging, and they expect to see some of the larger corporations who have large square footage not needing that large square footage and coming into the co-working spaces. In addition, I had a call with a corporate CEO this morning, and I asked him exactly this question: is what is he doing with his company? And his response to me was that on the corporate side, they're going to keep everything as is, but in their remote, in the remote locations where they have their offices, then they are going to be, especially if it's on month to month and they can get out of it, they are going to be downsizing and putting those employees to work at home on the remote side. So I think the real estate sector is really, I still think it's an unknown. They're just like on the venture capital side, there are industries to be capitalized on, and there's challenges as well. I think on the smaller on the smaller companies that are looking to cut expenses, cut costs, they will automatically go remote. In addition to the large corporations that have large square footage and they're able to get out of their leases, they may transfer over to some of the co-working spaces. So there's definitely going to be shifts within the real estate sector. And I think it's, to be determined, but there's a lot of movement, and it's complex. So I know that there's many folks on the real estate side that are trying to navigate. There are some great organizations in Arizona that are working with tenants as tenant reps to be able to both work with landlords and to be able to keep the stability within the market here. But I don't have an answer for you, Eric. I think it's still, we're not far along yet to have a conclusive understanding of what the ramifications are going to be.
Yeah, absolutely. And for anybody out there watching who is, again, interested in the real estate market, I believe it was a couple of weeks ago, we did a regional report with some of the industry's top professionals there. That is available on the GPEC website, gpec.org, again, talking about the real estate market and those questions, Leib, that you were just talking about. Another question coming in, and we will bring Ulya back into the conversation. I think a lot of people were excited to hear about Phoenix being a hotbed for 3 deals. What factors should Greater Phoenix keep emphasizing to attract VC PE firms to focus on the region?
Oh, well, so the one very compelling factor obviously is the cost base, right? So when you see that we are, our neighbor is the Silicon Valley side of the fence, what we are finding is actually we have seen companies and entrepreneurs moving here, not just from Silicon Valley, but even from Boston. So one of the things I hadn't realized, I moved myself from New York to Phoenix, and one of the things I had not realized is that there are no natural disasters in Phoenix. So most of the disaster recovery centers are actually in Phoenix. So I think from just continue to attract the entrepreneurs and the investment dollars. And by the way, the other thing that I was told was that if Phoenix is considered to be a flyover zone, investors don't stop over in Phoenix. They go to Silicon Valley, even Utah and Denver, Colorado, and not Phoenix. I actually think, what's happened is investors are like fishermen, and they would go wherever they can find fish. And we actually have very good quality fish in Phoenix. As we are finding out, when Silicon Valley pipeline of golden seeds went dry, they actually officially thanked Phoenix yesterday for continuing the great supply. So one of the things that we started doing 2 years ago, we started organizing what we call Longevity and Wellness Showcase in Phoenix, where we invite different types of investors to come to Phoenix, and we select 8 or 9 companies to showcase. And you would be surprised that we do this January, February every year, and we've had investors, VCs, PE folks, family office folks coming from Chicago, from Boston, from Denver, from LA, all over. Because as I said, they did not know we have all these great companies and great investment opportunities. So I think more, I guess, pushing that more and providing more visibility and forums and vehicles to make this more visible, that there is great investment opportunity here.
Yeah, that's great. Thank you for that, Ulya. And Brian, I mentioned we had a question come in for you. Let's go back to Silicon Valley now. Here's the question, Brian. We saw many fintech companies like PayPal, Square, Cabbage partnering with banks to implement the SBA Paycheck Protection Program, PPP. Do you expect more fintech companies will partner with SBA to be SBA 7A lenders and further develop small business lending?
Tricky question. Look, I think we can sort of debate on this this panel on how the SBA program was administered. I think the intent of the program was to get as much dollars in the hands of the people that needed it very quickly. The way they needed to do that was those that already had the infrastructure and primarily KYC capabilities, that had relationships with these small businesses and entrepreneurs that could sort of quickly vet them and get them through the process. At least what we saw on our side in our own portfolio companies is that the banks, and there's no rhyme or reason or precedent for how to deal with this, were optimizing around their best customers, ones that they had material debt financing into. So that's why a lot of the public companies, and not to name names, got sort of some backlash from PR for receiving those loans versus in that first batch. I think the intended use of those funds was more to go to the small business owners, the restaurants, the dry cleaners, et cetera. So you saw the SBA sort of go and Treasury sort of revert the entire other way and basically put the fear of God into entrepreneurs and boards on validating sort of the need of proceeds for its intended use. And finally, they've kind of now solved it, and over the past week or so have given much more clear guidance that I think works for both sides. Look, I would to answer the question directly, I'd hope that we don't find ourselves in a situation like this ever again. But certainly can never say never. But I do think that this exposes the real need, right, for a lot of these banks who are legacy institutions off of primarily legacy IT infrastructure. They sort of needed to partner with the tech incumbents to even help facilitate the SBA loan process. And so this would probably only catalyze the digital transformation of some of those banks, as we're seeing in other sectors of the economy, right? Whether it's retail or healthcare or financial services, this is sort of condensing the need and really exposing what can happen when you don't have the most efficient systems in place.
Brian, you did a great job with that one. And I just have a follow-up, sort of what we were talking about with Ulya, since you're in Silicon Valley, the question of what should Greater Phoenix keep doing to emphasize and attract VC PE firms to focus on the region? It'd be nice to hear your perspective on that, being in Silicon Valley.
Yeah, look, I think Ulya hit the nail on the head, where investors are commercial creatures and they'll go where the opportunities are. I think it's also just a volume game where traditionally we haven't had to go too far to find really compelling founders and entrepreneurs, and a capital ecosystem where if something's working, you'll be able to send it to a friend or send it to another firm that you respect for additional funding. I think certainly in our own activity over the past couple of years, because the competitive environment was so intense for opportunities in the Bay Area. For example, in our new fund, we have 6 investments. All 6 investments are outside the Bay Area. It wasn't by design, but it is just, I think, a organic thing that I think a lot of funds are feeling that are, and we have a relatively large fund. It's $200 million, but doesn't compare to the billion-dollar funds that some of our competitors have. And so for a fund our size and in the valuations and ownership targets that we want, a lot of those opportunities we were finding outside the Bay Area. I guess I would say to Phoenix and broader Arizona entrepreneurs, play to your region's strengths. I think you have a nice political and legislative body that is very accommodating and supporting and wanting to fuel the tech and entrepreneurial ecosystem within the broader Southwest. And, at least from my vantage point, healthcare in particular, there's many resources. The first wave of digital healthcare were consumer apps primarily that sort of existed outside the healthcare system. The next wave of healthcare startups are going to have to interoperate with the health system, the provider networks, and the payers. And so you have, fantastic assets like Dignity Health and Banner Health, and we have one company in our portfolio that's about to sign a meaningful partnership with Dignity. I think companies like that can exploit and leverage the legislative environment and just the corporate environment that exists in Arizona will, at least in my mind, stand out because it's a significant competitive advantage.
Yeah, thanks for that, Brian. And we have a few questions coming in, very similar here on just the process. And so I'm going to bring Sydnie and Tim into the discussion here. And Sydnie, we'll start with you. What insights can you provide for small to medium-sized businesses who hope to make a connection with a potential investor? I think there's just a lot of questions on how the actual process works.
Yeah, great question. So I'll just kind of speak from our perspective, and I think this is probably, to an extent, largely sort of what will be found with other institutional groups. So on our end, I would say first we have kind of the ways that we source deals. One being warm introductions, so leveraging our own network, and obviously that's sort of a surefire way to get a meeting, so to speak. But we have a pitch form on our website where we have inbound interest coming our way, and we look at each and every one of those submissions, and then we'll reach out to companies that feel like they could be a potential fit, and we'll have sort of a preliminary call, ask some questions about the business, understand the entrepreneur and the company a bit better, and then we'll kind of take next steps from there in terms of whether it makes sense to present to the broader team or move into a diligence phase. So at a high level, I would say the process, particularly for somebody who maybe doesn't have a direct tie with the group that you're targeting, probably safe to expect some things kind of along those lines, having a pitch deck prepared and kind of probably a 30-minute discussion just to keep it high level, understand the basic premise, and see if there are there's a potential alignment with the high level criteria. And then I would say on the kind of, that's the introduction side, and then diligence can last, a couple of weeks, couple of months, depending on the needs of both the entrepreneur and the investment group as well, and where things are in process wise. And so hopefully that answers and sheds a little light on what the process kind of looks like.
Yeah, it does. And I'll bring Tim in to follow up that question. Sydnie was talking about, a pitch deck. What are some other key components as an investor that you are looking for that'll help you determine if it's a good fit?
So also we engage video. So certainly a 3 to 5 minute recorded Zoom pitch that includes your pitch deck. Just like Kickstart, we have our application as well embedded online. So at canyonangels.org, go to entrepreneurs. We use a deal flow management platform called Gust that's shared by hundreds of other angel groups across the country. So the application and the information, the deal flow, the deal documents themselves, all are embedded on that platform. But really the critical piece for angel groups is so often some existing relationship that exists with one of our members. And that way you have a deal lead when you come into the group. And how do you do that? Well, so often, at least through the networks of Phoenix and Arizona and through Invest Southwest, for example, there are multiple incubators, multiple pitch competitions, things like Venture Madness, things like other great incubators and co-working spaces that really become filters. It's through there that you find those individuals who are mentors, that are also investors very often, have the relationships and the trust. Sometimes it's through law firms, sometimes it's through other structures. But when you have that credible individual in the community already to help make that introduction, it expedites that process. And from there, then it's the actual pitch and everything else to follow up. And similar timescales, often weeks for basic due diligence, and sometimes nothing happens at all. And you never know. With angels, it's like herding cats. We simply can't tell.
No, that's great advice, Tim. And I have a question coming in that I'll ask each of you, and we can go through this quickly because we're running out of time here. But we're talking about post-pandemic world now, what type of technology-based solutions interest you? And I'll just bring each of you in specifically. And let's start with Leib. What type of technology interests you the most post-pandemic?
I mean, healthcare is, I think, on everyone's radar. It was mentioned before that there's been companies that had, relative revenues last year, and in the first quarter, they've matched that just in the first quarter. And, we've been fortunate to see that with our portfolio companies. So healthcare is going to be definitely one of them. There's going to be on the consumer side, there's going to be large enterprises looking to how to re-engage their audience. So whether it's going to be on the analytics side, the AI side, to be able to understand those analytics. I would say those are two prime sectors that we're seeing a lot. Fintech as well. There's so much movement going on, and with so much rapid change on the financial side, finding the best mechanisms to either expedite processes. So I would say those are three areas that for the last 20 years that we've focused on, whether it's going to be the fintech, we've got cybersecurity as well, but healthcare and digital health, healthcare IT are definitely ones that have prospered. They're definitely going to be appealing to investors now, but seeing whether that's going to be sustained post COVID-19, I do think so, and ones that we are keeping our eyes open on.
Ulya, I'll bring you in. Speaking of healthcare, you mentioned telemedicine. I know we haven't really talked about it too much, but wearable technology, what are you looking at post-pandemic?
So post-pandemic, we are continuing to look at, firstly, businesses that not only have scalable technology solutions and are agile and can pivot easily, but also businesses that are in a good position to be able to use artificial intelligence and machine learning. Because, I see a lot of businesses throw those terms out, but ultimately what it is, having large sets of data that you can get insights from the data and then use those insights to refine your model to do better targeting, whether it's targeting of consumers or patients and so on and so forth. So we are focusing on the healthcare delivery models. As I said, my interest is in longevity, wellness, and healthy aging. And Phoenix is also very unique in that regard. I don't know of any other city that has 1,400 senior living communities within a 40-mile radius of the city. So I tell everybody who's investing in healthcare and entrepreneurs that if you need a petri dish for experimentation for your new healthcare models and things, well, Phoenix should be your city. So we are looking at remote care delivery, again, the focus being having people age in place and in community, because that's cheaper for everybody and better for the person who's aging. So remote monitoring, remote care delivery, telemedicine, telehealth. Again, the wearables, for me, fall into more remote care delivery, because you can, through those variables, you can then start transmitting relevant data to your provider, et cetera. So those are, my things.
Yeah, and Brian, let's bring you in now. Leib talked about fintech. Again, is that what interests you the most in a post-pandemic world?
Yeah, well, look, I'd say that definitely fintech, definitely healthcare, but maybe maybe just throw out a different idea. So I've been trying to formulate an investment thesis around, I guess, what I'd call the automation of the service economy or the real economy. And I guess the overarching thesis is that there's going to be industries and sectors that are going to be totally, I'm convinced, that are replaced with either some general AI or robotics. Think agriculture tech or manufacturing operations. It's just a matter of time in my mind, and it's probably within a decade where that technology gets good enough to be better than humans, and certainly cheaper. There's going to be certain other industries, and certainly financial services one, healthcare can be another one, where humans are always going to be in the loop, and whether it requires a higher level degree, whether it's a business that is primarily driven through relationships and human touch. There's going to be a set of, I think, of software and productivity tools that make that human capital a lot more efficient. And so definitely interested in that and how the pandemic has accelerated the adoption of some of those systems. I'd also say that I'm very intrigued at how the landscape of education will change. And I think this has been an ongoing development over the past decade or so, right? Where it may not make a lot of sense for someone, particularly in a recessionary environment, to take out a 4-year loan to go to a 4-year college, to get a degree that doesn't, entirely enable them to get a job, right? And so if we believe that software is in the world and technology is just pervasive across every industry, what are the learning platforms, the online learning platforms? What are the vocational training schools that are going to be relevant that could be a replacement for the people that are coming out of high school and trying to make that decision on a 2 to 4 year college degree or going to a vocational training camp?
Yeah, a lot of questions around education right now, Brian. Let's bring Sydnie in and your thoughts on what you're most interested in this post-pandemic world.
Yeah, it's a great question, and I appreciate what others have shared as well. I would say, so kind of quick, at a high level for us, we've always sort of been industry generalists. We do have an affinity for B2B SaaS solutions. Certainly there are going to be, and I kind of touched on this earlier, but behavior changes. There will be just changes across the board that will be lasting from this crisis. And I think that the magnitude of those changes is obviously yet to be seen. And so I would say we're certainly cognizant, and I'm certainly cognizant of the fact that there are certain industries that will look entirely different post-crisis. I kind of appreciate specifically what Brian said and would echo some of that, and would say also maybe what I would add is on our end, I think, and this is sort of an indirect question of the answer, but we've always sort of had an emphasis on focusing on the founder. And I think that's especially important at the seed level where there's just limited data to go off of. And so really focusing on who the entrepreneur is and their ability to pivot at a time like this. Is there a way for them to repurpose their technology? Are they the type of entrepreneur that will be thinking in that way and have the resilience to overcome a crisis like this? Again, obviously, hoping that something like this won't happen. I think probably in the distant future that we'll ever be experiencing something even close to this. But the point being, I think our focus is first and foremost the entrepreneur, obviously focusing on businesses that are fundamentally in an industry that is in alignment with the venture model. But I think it's just hard to say at this point what will be interesting because there's just so much to yet be learned on what things will look like post-crisis. And so I guess the short answer is kind of, TBD to some extent. We're trying to really just kind of, I think, look at things one day at a time and understand kind of as things are evolving, taking a sort of, thoughtful approach moving forward. And so that's what I would say in terms of post-crisis.
No, I love that perspective. We all talked about what industries, and then you shifted to the entrepreneur and, the founder themselves. And, you mentioned in your earlier remarks, so this is the greatest opportunity for them to step up. So again, great advice for those small business, medium-sized business owners to hear. Tim, let's bring you in now. What you're most interested in post-pandemic?
What we're looking at right out of the gate for our June meeting is artificial intelligence companies. So we've got 2 on deck already that one pivoted directly into the healthcare space, and right out of what they were doing with retail, and they literally took the same technology, found a new application for it in health clinics using heat sensors and cameras, which is what their original focus was. But they went straight to revenue right out of the gate. So their explosion is just fascinating to me. And I'd like to see how not only artificial intelligence, but we've also seen the rollout of 5G, which means that the sensor capacity across dense urban environments is exponentially available. And so that means so many new technologies can begin to be applied. And we're just beginning to tap into that. So I look for those groups, those companies that have the ability to incorporate the mobile technologies and sensor technologies on top of artificial intelligence and 5G.
Well, Tim, thank you so much. And I want to thank all the panelists. What great information we shared here today. And it sets up perfectly what we were talking about, how this is part 1 for part 2, a part 2 series, and part 2 is coming up May 28th at 10 a.m. That will be our Greater Phoenix Tech Challenge. Again, 4 Greater Phoenix-based businesses and or nonprofits will be presenting their technology and highlighting how they have pivoted their operation to meet the current demands of the COVID-19 pandemic. Again, so just on point for what we've talked about today. The businesses will be vying for a $50,000 grant provided by the Packey Center for Business Philanthropy at the Arizona Community Foundation. And again, if you're joining us right now, we encourage you to be there. Audience participation, we want to see that during the webcast. And if you're a business interested in the grant, don't forget that applications are due by May 22nd.